Hello, hello, hello. How is everyone doing?
Now this is interesting here. So no, just a sec. You said something.
Hello, who I'm talking to there. Uh, okay, time to rock and roll. Ellen and I were on an earlier meeting, and can you believe that we're halfway through October and that Alex has worked out that there's 50 days left of the year? When you start looking at it like that, it's like, yeah, we're already having conversations at a business level where it's like, right, we've got to obviously sit down and do planning for next year and everything. It's all like, it's quite surreal how quickly this year is reaching crescendo. Anyway, let's rock and roll. So what we're going to do is the usual. Welcome, everyone. And if you've got any questions about anything, let me know. Specifically this week, I think one of the things that I would like to talk about is what we launched on Tuesday night, which is the data centers. And if anyone's got any questions around that, I would like to talk to that a little bit and what that means. I did make some videos and emails just yesterday. And and then the other thing that I want to go through is every week we'll go through the weekly wealth strategy. So before I get going, are there any questions around the data center launch that happened on Tuesday night? I'd be interested to know if anyone's got any questions. And while I'm waiting for any questions, I thought I would share. I'm not sure if I mean, some of you have been part of the community for a while. Some of you are shareholders. Some of you are thinking about becoming shareholders. I've been investing now internationally for 21. Well, I've been helping people for 21 years. I've been doing it myself for 28 years. And, I talk a lot about getting access to the right information, the right partners, getting access to the right deals, etc. What I find absolutely phenomenal, and I'm not sure everyone truly understands the magnitude of why this, what this opportunity is about. And don't get me wrong, it is a higher risk type investment. It is a high growth, high opportunity, is opportunistic. But I think what really excites me is that our purpose, and for those of you who've done Wealth Going Global, or the challenge, will know a lot about like and my purpose and why we built this business. And if you sum it up in one simple word, it's to help everybody invest like the top 1%. And I've got this belief system that, and I don't think it's just my belief, I can prove it to you, that in 2010, when we had the global financial crisis, 2008, 2009, 2010, the wealthiest top 1% owned about 50% of the world's wealth. Do you know that today it's about 65%? Okay, I should actually Google it to get the exact number. I don't know the exact number, but I know it's like it's geometrically moved. And although the wealth gap is the biggest problem on the planet, it's not getting better, it's getting worse. And the reason for that is that they invest in better assets. I think that's the single thing. But the other thing that whether you like it or not, and to the ladies in the room, you're not going to like this either, but in terms of venture capital in America, there was a stat that came out, and it's old now, it was at least 10 years old, where 90%, 96% of all venture capital went to university students, generally white males from the top 4 universities in America. Like, how's that for a disproportionate amount of capital going to a very small group of one group of people? Okay. Now, what's interesting in this situation, and people say to me, well, how did we get access to this deal? Well, I've known Ryan for 3 years. He used to be part of DWG, and if you're on our platform, you'll see that we've done 3 deals with DWG. And the person that actually owns that company and runs that company is a guy called Judd. And Ryan told us about a year ago that he was thinking of going on his own and joining his father-in-law. And anyway, he's now done it. And so, myself and Paolo have been talking to him for about a year about this deal and how we could get it and when it would be ready. And it's taken a long time. But in simple terms, we've managed to get a seat at the table because someone's married to the boss. Now, I say it with a smile on my face, but does everyone else understand that? like basically Ryan is married to a lady, and that lady's father is the boss. And that's why he's been given a seat at the table. And because of that relationship, we have an opportunity to participate. And so, there's a company that has a balance sheet of $30 billion and a revenue, profit and loss revenue of $100 billion a year. It's one of the top 20 biggest companies in Japan, and they're investing $30 million into this opportunity. And they're putting up their balance sheet to provide all the gas, which is the electricity, the power. And Ryan has managed to get a seat at the table in that investment at the exact same terms. I don't know if do you guys all understand? Do you understand how big this actually is? Like if we had $10 million, any one of us on our own, $10 million, it would be irrelevant. No one would care. We wouldn't even be in the room and be at the table. And so, for me, when I look at it and I summarize it just in my own head, and I don't know if you saw the emails I sent out yesterday, but in simple terms, you're getting access to an institutional partner, effectively the top 1% of the top 1%. I mean, literally, they've run some of the biggest and most respected venture capital companies, investment firms. They've had a combined IRR, internal rate of return, on all their exits of 38%. Did you hear me there? 38%. Okay, so this is not a bunch of 20-year-olds that are trying to figure this stuff out. This is a group of people that have been doing this for decades across multiple different sectors and have a combined exit and return. So combined exits in the billions of dollars and the returns of 38%. And then you marry that together. So that's the partner. And then you marry it together with the asset class that, in my mind, excites me the most about basically any asset class. Literally, it excites me more than Bitcoin or gold or silver or the stock market or property or anything, because I truly believe that it's going to be the backbone of this digital economy. And then you take a third part, which is where this demand is growing exponentially every 6 months. And unless you see the internet slowing down, or unless you see AI slowing down, and people using their phones and whatever, unless you see that slowing down, I think data centers are the demand is only going to accelerate. Again, I welcome a debate on this if anyone disagrees. And so you've got demand doing this, and then the problem with supply is electricity, is power. And how have they solved the power?
Yeah, well, who's Uncle Stumpy?
Pardon? Oh, I'm just going to mute you, Chiba.
Oh, which side is it?
So how they've solved the power thing is that they're using this Japanese conglomerate's $30 billion balance sheet to effectively reserve the gas, and they're going to use the gas to generate the power. So you've got the demand solved, you've got the power solved, you've got the partner with tremendous amount of credibility. You're in an asset class where it's a very resilient asset class. Obviously, you've got to have a partner that knows what they're doing. And then for me, we're also getting a seat in the very first round. It's not the second round or the third round or do you guys understand why I got so excited when he literally told me about it? I was like, are you joking? I didn't think any of us would ever get invited to the table with these type of opportunities. And so I'd love to kind of just take stock there if anyone's got any thoughts on this, because I want to come back to the email that I wrote just yesterday, and I'm not sure if you saw these emails. I'm just going to share my screen here quickly. And some of the emails haven't even been shared with you yet, but I just want to take you through the logic here. So if you take it, you've effectively got every few decades, a new wave of innovation reshapes the global economy. The Industrial Revolution brought factories, the internet brought connectivity. Now artificial intelligence is bringing something even greater, and it all runs on data centers. So remember that AI requires 10 times the computing power of just the normal internet. this is the proverbial picks and shovels in the AI gold rush. You know, who is Overwatch? So Overwatch is the company. And, you know, again, data centers are doubling every 6 months. Data centers are the backbone of the digital economy. Supply is severely constrained. They are partnering with Meta, Amazon, Microsoft, Oracle, and CoreWeave. There's a $30 billion partner with their balance sheet and $100 billion. They're putting $30 million, and you get a rare chance to literally invest at the same terms. Everything I try and teach: right time, right partner, right sector. So that's the one email. Then this email should have gone this morning. But why this you know excites me is this exponential demand, severe supply constraints, and institutional validation. So global giants are fighting for capacity. Our partners are already in discussions with AWS, Oracle, Meta, Microsoft, etc. And then the last one I just wanted to share with you here was this one here. So after nearly 3 decades of global investing, I've seen many assets rise and fall, but nothing compares to what's happening right now with AI and data centers. It's the perfect storm: exponential growth and demand, severe global shortage supply, and a world that now runs entirely on data. Our partners are reshaping it for all the reasons that I mentioned. So I think, like, I've just tried to highlight it, and I know I've verbally told you everything that I've written down there. But does it make sense to you? I'd love to have a bit of a discussion around this. Is it, you know, has anyone got any comments? Don't leave me hanging. No, but I'm really interested in what people think, because this for me, remember last week we did a session, if you were here, on knowing your why and getting clear on your why and getting clear on your purpose. Well, one of the things that I believe that I'm truly gifted with is that, firstly, at around 35, I figured out what my why was. Why am I on this planet? And you know, when you get to live your purpose, it's quite an exciting thing, you know, right at that center of Ikigai. And then this week is really, and this type of deal is really representing that, because every single person here has the ability to participate in that deal, which is truly living up to that purpose. So, okay, so what did Shona say? My partner strongly advised me not to invest, as she says they are building too many of them in the US. Is this something that came up in the due diligence? Yeah, look, so Shona, I think it is something to always be aware of in any sort of, what do you want to call it? I'm trying to think of the right word now, boom, where people, you know, like, think of the dot-com boom in you know, the late 90s. I think you do have to be aware, and I think it's something you need to be very, very conscious of. What Ryan spoke about was that, again, it's this breaking away from the mom and pops. So there's a lot of people doing mom and pop data centers where they're doing these small scale things, and you know, this is being played at a whole nother level. So back to your due diligence, you know, I doubt that the one of the top 20 companies out of Japan would be not only putting up their balance sheet, but investing $30 million if they hadn't done their due diligence. I would doubt that those partners, and again, let's pull this up, because I think this is really, really important. And I'd actually put this in the school chat yesterday. If you saw my school chat, look at the caliber of these partners. I'm just going to get it up for you. Look at this. Okay, and then ask yourself the question: do you think that they could do due diligence? Okay, so they've deployed $3 billion in commercial and industrial property. Okay, they've done 7 million square feet, and they've got an average return of 38%. In the high-tech sector, that's managing partner founded data center VR systems. They've done 220 million, and they've got 144%. In renewable power projects, managing partner developed over 200 million solar, wind, fuel, 300 million, 19%. In venture capital, managing partner launched and ran Northgate Capital, which is one of the biggest venture capital companies in America. They deployed $4.8 billion and have got an average return of 24%. They were one of the first investors in Facebook, by the way. And then public offerings, the managing partner led the GCU, I don't know what that stands for, GCU IPO, but anyway, it was an IPO worth $4.3 billion. What would GCU stand for? Does anyone know? But anyway, it was one of the most, what Ryan said in the launch was that it was one of the most successful IPOs in American history. 437% return. So I just want to be clear, because I think it's important, is let me just pull this up. I'm not saying that there's no risk. I think it's very important that I clarify that. I'm just logging in here now quickly for you. So if we go to the deal, you'll notice, and this is why it's always useful to learn how this works. But if you go to the deal and you go to risk, it's sitting here in opportunistic. Okay, so it is high opportunity, but it's also higher risk. And the reason for that, and you can go down here and you can look at the risks. There's high potential, high risk, liquid infrastructure. So there's construction and development risk. So it's called execution risk. There's obviously technology. There's, so there's, like, we've tried to put the risks down. But I think the important part to Shona's point is that you do need to be aware there is definitely a component of risk. And that's why it's put there as opportunistic. And at some point, you do have to be careful in any boom not to be involved in what's called an oversupply. But again, that's why I'm excited about this opportunity, because of the caliber of the partner. That's the best way to describe it. Like, for me, if it was little Joe Soap and they're in Texas and this is their second time they're doing something, I'd be much more nervous. And I do think it's something we need to be aware of. If you look at data centers, I've read reports, both very positive, and one came out fairly recently from The Economist around just saying, be careful, because obviously everyone's jumping in. Marge said, if I had an investment that returning, say, 10% per annum, how would I work out how to compare the data center opportunity with the current investment? Cool, that's a good question. So, Marge, what I would do is let me pull up my IRR calculator, my returns calculator. So let me just get it for you. Actually, I'll do it so that you guys can use the calculator as well. So I'm going to share my screen again. Okay, so if I share my screen, so you've got the freedom calculator. Now, let's just show you where you can find that, basically. So if I go to Classroom and I go to Start Here, there are these lessons, like, and getting clear, and you can actually see the freedom calculators here, the wealth plans here, my wealth plans here. If you click on this, so again, it's in Classroom, it's Start Here, and it's Lesson 2. You can literally click on the freedom calculator and it brings up this page where you can literally download your own freedom calculator. So it's your own document. So you make a copy of it. So what I would do is I would go into this thing here, and I would do those returns. So if we just use your thing, Marge, you said you're getting a 10% return. This one's getting you about a 30% return. And I don't know if you want to tell me what the investment amount would be, but if you do, I could then just put it in to here, and it would calculate it for you over 1 year, over 5 years, over 10 years, and over 30 years. So anyway, let's just say 100,000. Well, I don't know. No, let's just even say 10,000. So you can see here the difference. So over 1 year at 10% versus 30%, you're getting a future value of $11,000 versus 13. The difference is 2, but we do actually bring this back into present day rates. So we've used a 6% inflation. So the difference would be about $2,200 in 1 year. In 5 years, it would be $20,000. Okay, this is on a $10,000 investment. And on 10 years, it would be $92,000. So it'd be about nearly 10x your money. And on 30 years, it'd be $12 million, $12.5 million. Does this make sense? That's how I would do it, Marge. Simply compare an apple with an apple.
Thanks for that, Scott. I guess I was wondering because, for the first 5 years it's going to be zero. So, so how do you factor that in?
Yeah, so look, I think it's a great
Bless you.
well, it's definitely, and that's why I wouldn't put all my eggs in one basket. For me, diversification is always a key. So the 10% that you're getting on the current investment, is that just the total return, or is some of that income, or is that expected capital growth, or like where would you find that? What is that? How does that 10%? How does that get made up?
That's literally just like a superannuation fund,
Okay.
and I'm not really contributing to it. It's just it is what it is, and the growth is coming from how that's been invested in stocks and so on.
Okay. Yeah. So look, I think the point being is that in any balanced portfolio, and again, this is where Anthony and them are more qualified to have this conversation in terms of portfolio construction with you. But what I've learned is that, on the one hand, you're going to have that, which is your superannuation. It's safer, it's kind of steady Eddie, in terms of the return. And then this is more opportunistic growth related. And as you rightly said, there's no cash flow while they build the project. So for the next 3 years, they've got to build the project, they've got to stabilize it, etc. After 6 years, we will get 2.5 times our capital back. So that basically means if I've invested $10,000, I'm going to get $25,000 back. Okay, so you got all your money out, and then you can still stay in the deal, and the expectation is sort of 7 times your money over the 9-10 year period. So for me, it would be a balancing act. I wouldn't say either or. Like I wouldn't take, if I had to buy egg, I wouldn't take the whole egg and put it in either basket. I would diversify.
No, I wouldn't do that either. But it was just out of my own curiosity how to compare this opportunity, or for any other opportunities on the platform. How do you work out whether or not your money's better off where it is than not all of it, of course, diversify and everything, but how do you get a good comparison?
Yeah, so I think I think it's a fantastic question, and I think there's always kind of 3 questions that I would ask yourself, if or I would ask someone if I was working with them. Firstly, what do you need? Okay, so like some people just want growth. They're like, I don't want any income. I just want my capital to grow. Some people just want income. They're like in retirement and they need income. You know what I mean? So the first question is, what do you need? Because what do you need is going to determine the strategy, like if that makes sense,
Yeah.
The second question, for me, when you're wanting to compare any investment, you can literally compare the stock market to gold to a house, any investment. The best methodology is to compare using IRR, internal rate of return, because then you're comparing you're using the same 1% to compare, different assets, different returns, because internal rate of return takes everything into account. It takes time value of money. It takes how long you're in the deal. It takes the cash flow that you're getting out of the deal. It takes the capital growth. I mean, there's 27 variables to be exact. And so what it does is again, you're getting 10% on your superannuation. This one, you 30%. Like that's how you can compare. Does that make sense? Between 2 investments. And then the third question is risk, because that's why they talk about risk-adjusted returns. Is that if you're getting 10% and it's in a safe investment, and you're going to get 11% in Bitcoin, it probably makes no sense, because you might get a slightly higher return, but there's a lot more risk. And so that's why they talk about risk-adjusted returns, where it's like, well, does it make sense to take the risk in terms of that process? And so like just to remind you of those 3 questions, and again, that's why I said it's a fantastic question, because they're really the 3 questions we should always be asking ourselves, right? What do I need it for, firstly? Because if I need cash flow, then this deal is not a good deal, because for 5 years, there's no cash flow. 5 or 6 years, I don't know exactly the time frame. But if I need growth, like I don't know, for those of you who've known me for a while, we haven't had a project that's got this amount of potential yet, not one, ever. So that would be your first question. The second one is, if you're wanting to compare returns across different investments, then IRR is the way to do it. And the third one is what's the risk? And again, in this situation, that's why we try and use. I'll go back to just showing the platform here. And again, this is not our system. This is the way it's done worldwide. Is we will we use this this is the global standard. This is how they do it. And so this is opportunistic. And so I would, Marge, have you done with Anthony, have you seen where he takes, has taught us the bucketing approach, where there's 3 buckets and you haven't? Okay, let me show you something quickly. So all of this stuff is what we're going to be working through in terms of this wealth pack. What am I sharing? No, wrong screen. Hang on, I'm sharing the wrong one. So this wealth pack that I've put together, and that we're building out into a resource library, but the one that I'm referring to now is this one. Okay, so I'll just put this in the chat for you so that you've got it and you can read through it. But basically, Anthony takes us through, and he's done this a couple of times. He does it at the Wealth Weekend as well, because it's so core. But there are basically 6 pillars to your portfolio construction. The first is your timeline. The second is your risk tolerance, which is what we're talking about now. The third is your asset allocation. The fourth is diversification. The fifth is personal goals and outcomes. And the sixth is monitoring, measuring, and rebalancing. And then the second part is they then build that model. And then the third part is the bucketing strategy. And this is what I was talking about. So if you look here, you've got bucket 1, which is basically your short-term needs. Okay, let's just make this a bit bigger. So meet immediate cash flow needs. Its assets are cash, fixed income, conservative income, funds, low risk, creates low volatility, high liquidity. Then bucket number 2 is essential capital. So this is where you refill the income bucket over time. And this is where it's you're getting it's like a 6 to 7 year time frame. And then you've got your growth bucket, which is 7%, 7 years plus. And it's maximized long term. It's all about capital growth. You've got private equity, growth, equities, alternatives, property, outpace inflation, and deliver legacy of wealth expansion. As bucket 1 is depleted, profits are trimmed from bucket 2 to replenish it. As bucket 2 matures, growth from bucket 3 replenishes it. This creates a self-sustaining loop that balances short-term needs with long-term growth. Basically, in simple terms, this opportunity, this data center opportunity would sit in this growth bucket. Does that make sense?
Yeah, it does. Yeah, that's helpful. It would be a good document to have a look through. Thank you.
I'll share this. I'll put this in for everyone.
Thank you.
I find it so interesting because, and I know we go on and on and on about this, but why I was not taught this at university, I have no idea. And it's not like I did a BA in arts. I did economics, finance, accounting, and no one ever taught me any of this stuff. So I find it bizarre that we weren't taught this stuff. And I only started learning this properly in the last 2.5 years once we partnered with the family office and obviously had the mastermind. Because for me, spending so much time with Anthony around portfolio construction, and that's why, Mark, I'm going into detail answering your question, because actually it's such a good question, and most people don't know how to do this. Does it make sense? So the problem for most people is that they come along with a deal like this. Let's just say I'm being hypothetical, and I come to you and Shona, I go, "Hey, I got a great deal. It's Bitcoin. It's going through the roof," and people just look at it and they go, "Yay," and they make a decision, yes or no. Or should I buy this house? And they make a decision, yes or no. And it's about the deal that they're making the decision, or the property as an example. But where they get it completely wrong is they have to start with the plan first. And then the plan will determine whether you should put that asset into it. Do you understand? Like it's the wrong way around. Okay, so people are out there running around trying to make investments, but they don't have a plan. And that's why when you asked the question, I started off with those three questions, because the first thing is like, what do you need? Well, that's your plan. Like your plan's going to tell you what you need. Then how do you compare apples with oranges? Well, that's your IRR. And then thirdly is your risk, because you might get 100% return in Bitcoin and you might lose it all. Then you've achieved nothing, So yeah, I don't know if that. Please send it in an email if you can. Okay, yeah, no problem, Ellen. I'll do that. So yeah, excellent question, Marge. I'm literally sitting here thinking, shit, I could do a masterclass just on that question itself, because I think it's such a relevant question for so many people in terms of how do you make decisions, in terms of that process. Okay, anything else with regards to, thank you, Kevin, for GCU as Grand Canyon University. I mean, it's supposedly one of the best IPOs in American history. I've never heard of it. I'm embarrassed. I don't know anything about that. I don't even know what it is. Okay, it doesn't look like there's any other questions. So what I want to do now, just conscious of time here, is because I'm going to share this and then I want us to break into groups. I think it's very valuable for people to talk. So what we're going to do each week, like I promised, is we're going to be working through this wealth pack. So last week we did the Return to the Inner Child, if you remember, and it was this document here. And for me, some people think that this is all woo-woo stuff, but actually, I think if you're living your purpose, why you're on this planet, it's all about fulfillment, which is one of the most valuable pieces of wealth that you can actually have. The next one is the investor journey. Now, this one's quite an interesting one, and I wanted to share this with you. So I don't really need to purport and teach you guys this, because you're either part of the Wealth Hackers or you're part of the mastermind. But I wanted to share this because I want to show you how you can accelerate your path to mastery. So learning how to invest isn't just about knowledge. You're looking at the right screen. Hey, you're seeing synopsis. Yeah?
No, we're not seeing the right screen.
I think Overwatch Capital Management.
Yeah, sorry. The guys have messed with my thing. I know I've said this for a long time, but it's like completely buggered me up, because I normally share the one screen and now it's the other one. Okay, so what I was just trying to show you, okay, well, let me go back, because what I was trying to just share with you quickly was we did this last week, which was the return to your child, this document, which was document 1. And then hopefully you all did the exercise, or are going to come back to doing it. And then document 2 is the investor journey. How do you accelerate your path to mastery? So learning how to invest isn't just about knowledge. It's about how you learn, who you learn from, and who you learn with. The investor journey follows a predictable path from novice to experienced investor. And the pace at which you grow depends on strategies, mentorship, and the community you're in. Knowledge alone is not enough. Credentials alone is not enough. Even hard work alone is not enough. What separates the average investor from the great ones is the way they accelerate their learning journey. So this is the learning types that shape investors. Now, I don't know about how many of you have followed this path. I know I certainly have. So if you look on the left here, you've got pace of learning. So obviously low pace, high pace. And then the bottom here, you've got novice investor, you've got seasoned investor, and you've got experienced investor. So let's just give context here. So macro learning is big picture. So it's strategy, it's risk management, it's diversification, it's mindsets. It sets the foundation and helps avoid costly mistakes. Micro learning is tactics. So it's like asset-specific skills, deal analysis, market timing, technical know-how. It builds the confidence to act, but only works when combined with macro. Credentials is formal education. So like that's going to university or whatever. Provides validation, but really accelerates results on its own. It's useful, but insufficient for wealth creation. And then community, coach, mentor, mastermind, personalized guidance is the single biggest accelerator. Bridges macro and micro learning and unlocks mastery. Because what a lot of people do is they go to university and they learn about, I don't know, finance, economics. Maybe they do a course, even maybe like wealth going global, and they start to understand like the bigger picture. And then they do a couple of micro things. So they go and learn different tactics. Maybe they learn to invest in property or crypto or, day trading or something. And this is kind of where, so they go from being a novice, like knowing nothing. Maybe they read Rich Dad, Poor Dad. and then they start to learn and they start to understand. But then they tend to just sort of taper off, and then they want to go and get like more degrees and stuff. So I mean, this could be us at school, and then we go to university and we get some degrees and we learn some more stuff. And kind of we kind of dip down, and we, you know, as we get older, we kind of learn a little bit. But this is the kind of normal path that people take. The vast majority of people on the planet don't even do this. They don't even continue to learn. They're like after school. There's some ridiculous stat in America, and I don't remember it, but it's over 90% of Americans haven't read a book since they left school. And it's also why accountants, doctors, lawyers, all professions have to do their annual, I don't know what they call it, accreditations to make sure they continue learning, because the majority of adults don't do it. So they actually just go here, like down to bad. And the only way to go here in the great category is to have a balance between micro, you got the macro, micro, and then to have that coach community, etc. And that's how, you know, you can just really accelerate the growth in terms of the process. So I hope this sort of makes sense. If you look at it, like if you look at the stages here, the novice investor begins with macro learning, excited, pace of learning grows rapidly, risk, can get stuck in theory without taking action. So that's where you go in analysis paralysis. You're reading books, you're going on courses, but you're not actually investing. The seasoned investor often returns to macro focus, pace of learning may plateau, risk, overconfidence, or reliance on credentials alone, understands how important a like-minded community is, and understands the importance of having a team. And then finally, the experienced investor breaks through by combining macro and micro. With a coach or mastermind, the pace accelerates dramatically, and this is where investors become truly great. And then part 3, the divergence, why some soar and others stagnate. The great part blue is where investors re-engage deeply with micro learning, guided by coaches and mentors, and see exponential results. The normal curve green is where investors maintain steady progress but never achieve exponential growth. This is like, Alan, I know you're online. This you've often spoken about this frustration that you've had because, you know, in your career and whatever, you know, no one ever actually taught you how to do this stuff. And this is where sort of most business people just find themselves in this section here. And then the bad part, red, investors stagnate, relying on outdated thinking or going it alone. The science of accelerated success. According to Deepak Chakra, your probability of success depends on who you journey with. If you do it alone, you've got less than 50% chance of success. If you do it with a spouse, partner, friend, you've got a 60% chance of success. And if you do it in a like-minded community, you've got a 70% chance of success. What I find fascinating is that nature also says that a bird flying on its own versus a bird flying in a flock can fly 70% further. And then according to Harvard, with a coach, your chance of success is 400% higher. And in a mastermind, you reach your goals 5 times quicker, simpler, and safer than even with a coach, which if you do the maths, I mean, that's 4 times, that's 5 times. It's effectively 20 times better if you're in a mastermind than if you're trying to do it on your own. The lesson is clear. Wealth creation is not a solo sport. It's an accelerated, collaborative journey. So yeah, that's and it just says if you want to, you know, join a community, work with a coach, step into a mastermind to unlock exponential progress. So I think it's fairly self-explanatory, and each one of these lessons is sort of taking you on a journey to show you how you can continue to grow. And I actually don't remember where I got this from originally, but I really enjoyed it when I saw it because it actually made perfect sense to me. The difference between novice investors, you know, the kind of the middle of the road, and then the experienced. So yeah, I'd love to know. I'd love to know what your thoughts are and whether that makes sense. And what I suggest we do is let's take 10 minutes. I'm going to take the group and I'm going to put you into groups of 2 or 3 people. And I'd love you to chat through 2 things. I'd like to talk through like the data centers and you know what it's like to now be able to participate, truly sitting next to the top 1% and investing alongside them. And 2 is, what does it mean? I'll put this doc in the chat for everyone so that you've got it. But what does it mean in terms of this learning process? Because I really feel very strongly that we, mustn't just be me doing the talking. I want these lessons to synthesize. So I've shared it there in the chat room for you, and I'm going to put everyone in rooms, and we'll take about 10 minutes, and then we'll come back and regroup in terms of the last, how many people we've got? 17. So I'll make 5 rooms. Yeah, and just, I'll see you just now. Minutes. Please join the rooms if you are assigned a room, because otherwise we've got to move people around to make sure people are in the room. Everyone should be, you should have your rooms now. You guys back? No. Hello. So, it was nice meeting your fellow like-minded people.
Yes, it was.
Any insights from anyone? These Q&As, I expect interaction, and if I don't come prepared, we'll all just sit here and look at each other. So by getting into groups, obviously it allows people to chat. Any insights that came out from anyone? Yep, Shaman?
I'm sorry my camera doesn't work, but yeah, it was quite interesting. We were three people, so almost all of us got a chance to speak, although the third candidate didn't. She got 2 seconds. But it was very interesting because we were kind of different age groups, so we had different risk profiles. And so to discuss that risk and why maybe we would invest or not invest was a very interesting insight. And also to hear people, younger than me, for instance, and their way of thinking around it was very, very interesting. And I think it's really good to have these breakout rooms. It helped me a lot.
Okay. I can see lots of nods. So I will try, and I would actually appreciate it if I forget, because sometimes I do forget. Just remind me, just put it in the chat room. Say, hey, Scott, don't forget the breakout room, because I actually think it's really valuable if we spend 30, 40 minutes talking and then we have a breakout room to synthesize what we've spoken about, because otherwise it's just one directional, So any other comments, Chiba?
Yes, Scott, I think the previous speaker, I think she made a very good point, and we discussed exactly the same topic about 9 years to get yourself locked in for an investment that's going to be attractive versus somebody who's of a very younger age, but who doesn't have the means. So if the younger group will have the time, but they won't necessarily have the capacity to invest. So it depends where you are on the curve, in terms of capacity versus age.
Yeah.
Exactly the point. So, and the fact that we locked in for 9 years, and then also the value, which is 1,000 USD, which is minimum, which is close to 18,000 Rand for the South African investors. So is that affordable to dive in? Because, yeah, I mean, the Manhattan deal was also minimum 1,000. So some have invested in that and they locked in. So the question is, this latest deal is very attractive, I must add, from a personal point of view. But in terms of timing, that's the challenge, and making the decision.
Sorry, after you.
Your view on that?
Oh, look, I think everyone's different. I will say one thing. I've been doing this for nearly 3 decades, and I can't tell you. People always say to me, "When's the next deal coming?" If 2 weeks ago you had asked me if this deal was coming, I didn't even know about it. Literally, I reached out to Ryan, like I do, just to all the sponsors, going, "Hey, what's happening? Is there anything coming down the pipeline?" And he was like, "So glad you got hold of me." The thing got green lighted. Nice. I think, my view on it is when it comes to investing, you've got to be ready when opportunity knocks at the door. There's a beautiful saying, actually. I'll tell you what, I have this on my wall, by the way. So I'm going to pull this up. Let me just get it. It's a quote that I would recommend everyone actually puts on their wall. Churchill quote about being ready. Okay, how cool is this quote? Oops, I'm sharing my screen again. So I actually have this printed on my wall, by the way. To each, there comes a time in their lifetime, a special moment when they're figuratively tapped on the shoulder and offered a chance to do a very specific, special thing. What a tragedy if that moment finds them unprepared for that which has been their finest hour. And I think, I mean, it's a little bit philosophical to your question, Chiba, but there's two things I would answer to you. Firstly, you're not waiting 9 years to get your capital. You get 2.5 times your capital back after 6 years. So, you know, you're staying in the deal, but you're getting, like the best case scenario at a casino is where you go and you put your money down, you win, you take the capital you arrived with off the table. So you can basically actually lose nothing. And then your winnings help you make more winnings. Like that's sort of that sort of process. And then the second thing is the $1,000, you know, look, I mean, honestly, you know, when I was 35 years old, I was helping people invest and you had to have $100,000 in medical buildings. So, you know, $1,000 is nothing in the big picture of the world. No disrespect, but it really isn't. And I wouldn't ever think in rands if I was you. Because that'll keep you stuck in South Africa. You really have to be able to think in first world currencies. We do always try and make it as affordable as possible, but it also comes down to the developer. And, you know, they see it, it's quite interesting. Sometimes they see the huge benefit of it and the whole democratization and all that. And sometimes they just see it as like, you know, some particularly old school people see it as very, like they actually see it as negative. They don't want a whole bunch of, you know, $10 investors. So it's a perception thing, because we always try and explain to them that the technology takes care of everything and they don't have to deal with 1,000 investors that have put $10 in. But sometimes the partners aren't willing to. We are negotiating with them. So watch your emails. I hope I might have some good news before the deal closes. And Lorata closes at midnight on Monday. The reason it closes midnight on Monday, the money has to land in America in the account by Thursday. So if we close it Monday night, the team comes to work Tuesday morning. It's now closed. They then move the money from Europe. Remember, it's got to go from Europe to America. Sometimes it takes 24 hours. Sometimes it takes 48 hours. We can't afford to miss the opportunity. So that's why we close on Monday night to get it there by Thursday. Is the return guaranteed depending on how the project is going? No, Sherman. It's not. Nothing in a project is ever guaranteed. There's target. It's called target returns, and so yeah. Please, like basically nothing we've ever done is guaranteed. And you've got to be very careful of guarantees, because when people say that stuff's guaranteed, often it's only as good as the company and that sort of stuff. So one has to be very careful of the word guarantee. It's what you need to look at is its target returns. And just by the way, nothing's guaranteed. You know, if you had your money in a Turkish bank and the Turkish government took all your money, or Cyprus, you would have thought your money was guaranteed safe, which it wasn't. Will there be other phases of the same deal? No. Look, I don't know. I don't think so, because this is a once-off investment by the Japanese conglomerate, and we've managed to get a side door alongside them. There might be other rounds, but it won't be alongside the Japanese partner at the same terms. What happens if we don't raise the amount required within the platform? So Marge, the beauty is we always sit alongside the partner. So they're already getting $30 million from the Japanese partner. If they get $30,500,000 or if they get $30,200,000, it doesn't really make a big difference. So it's the beauty of being a sucker fish on a whale. I don't know if you all know what I need to bounce. I've got a 1 o'clock meeting, but you know the big whale, and you've got the little sucker fish that swims along next to it. That's the benefit. You know, in the old days, we tried to, and I've taught you guys this, the old school control mindset. We would have had to raise all the money, and if we didn't raise it, then the deal fell apart. You know what I mean? Whereas now we're just a sucker fish, which I believe is so much more safe for us as investors because of the caliber of partners we've got, but also we get to be in deals that we've never raised $30 million for a deal. So we just wouldn't even be invited to the table, you know? So anyway, I think on that note, it's a good note to end. Have a wonderful week, everyone. Alan, I've emailed you those documents. I am, and I have not forgotten about building out this wealth pack. I just haven't had the capacity. This week's been school holidays. So I've been trying to be daddy daycare and run a business. So only urgent and important stuff got dealt with, not building out. But I will continue each week to share them like I'm doing, and I will build them out into a full library as well for all of you. Have a wonderful week. And,
Just a quick one, Scott.
Yeah.
Would you mind very much to share the document on the inner child ikigai? Because unfortunately, I wasn't there last week.
No problem.
I would so appreciate. Yeah.
I'll put it in the chat right now for you. Okay. So it's in there
Thank
now.
you so much.
But yeah, try download it quick because I need to bounce. I'm supposed to be in a 1 o'clock meeting. Okay. Cheers, everyone.
Awesome.
Bye bye.
Thank you so
Done.
much. Ciao.
Thank you.
Nice question,
Thank
Mark.
you.